I talk with a lot of retail property owners on a regular basis, and one of the most common things I hear sounds like this. We're 100% leased and things are good. But I'm not sure many owners actually know what good really means or if things are really as good as they think. And here's why. Being 100% leased looks great on paper. It feels like stability. But sometimes what looks stable on the surface is actually quietly fading underneath. Over the past 5 years here in San Antonio, average retail rents have grown about 17%. That's solid, steady growth. But during that same period, property taxes climbed more than 30%, insurance premiums increased over 50%, and CAM and utilities rose around 25%. So while your rent roll might have gone up 2 or 3% a year, your expenses have been growing 6 to 10% a year. That gap, that invisible spread, is what's quietly eating into your net operating income or bottom line. In other words, you might be full, but your performance is fading. Now, most owners measure success by one metric, and that's occupancy. And I get it. We've all been taught that full equals safe, empty space equals risk. But full occupancy is only a snapshot in time. It doesn't tell you whether your rents are keeping up with inflation or whether your tenants are beginning to struggle under rising costs. It's like running a business. Being sold out doesn't mean you're profitable. You can have a full store of customers and still be losing money if your costs are growing faster than your sales. Real estate works the same way. 100% leased doesn't automatically mean 100% healthy. Now, if you're thinking, well, I have triple net leases, I'm good, I'm protected, you're partly right. Triple net leases shift the cost burden from you to your tenants, but they don't erase the problem. They just move downstream. When taxes, insurance, and maintenance all rise 30 to 50% in just 5 years, your tenant's occupancy costs explode. A 2,000 square foot tenant that once paid $8 per foot in triple nets might now be paying $11.25. That's about $6,500 more dollars a year, and that could be the difference between staying open or struggling to survive, even shutting the doors for good. So even though your rent checks are still coming in, your property's stability might already be under pressure. And if you're not reconciling triple nets annually and clearly, you're missing an opportunity to build trust and protect your income. But that's a conversation for another video. The best, most proactive owners I know don't stop at fully leased. They treat full occupancy as their starting point and not their finish line. They track net operating income or their bottom line quarterly, benchmark their rents against the market, and forecast expenses just like a true operator would, because they understand something simple but powerful. The goal isn't just to fill space, it's to grow performance. Stability isn't about how many spaces are leased, it's about how efficiently your property performs. So the next time you hear yourself say, "We're full and things are good," take a moment to ask, are things good because we're full or because every dollar is working harder for you? Remember, full occupancy doesn't mean full performance. And in this market, the better owners aren't just chasing occupancy. They're managing for profitability, resilience, and long-term value. Before we wrap up, I want to share a quick story from a recent deal, one that really captures what's working in today's retail market. We recently sold a strip center at 6330 De Zavala Road in Northwest San Antonio. Now, on paper, this property had some challenges. A few vacancies, a handful of short-term leases, the kind of thing that can make an investor hesitate. But instead of seeing it as a drawback, we reframed it. We built the narrative around potential. the value add opportunity that existed, and capitalized on current suburban strip center demand trends. Using market data to support the story, which told us that retail vacancy in this corridor remains below 5%, while new construction has slowed dramatically, all translating to strong demand and low supply, a very attractive and advantageous setup. So we priced it carefully, created a story investors could believe in, and the response was lightning quick and put my client in the position I want them to be in, receiving multiple offers, a bidding environment, and ultimately a closing that meets or outperforms expectations. And what I'd like to get across here is you don't need a perfect property to achieve a great result. You just need to position it correctly, understand the market forces at play, and communicate that story clearly. Thanks for watching, and remember, at the end of the day, the market rewards clarity. Knowing what you believe about your property, your numbers, and your next move. If any of this sparked a thought or a question, I'd love to hear it in the comments. You can always connect with me here or on LinkedIn, and I look forward to seeing you in the next one.